Hey, Anthony. We are continuing our FATCA series today. We're on episode number 5. We've talked about what is FATCA, what happens if you get a FATCA letter from your bank. And today we want to talk about reporting thresholds for FATCA. They are different if you live in the U.S. or abroad, and they also vary if you're filing single or jointly.
Correct.
Okay. So let's start with the basics. If you're single or file separately from your spouse and you have more than $200,000 of specified assets, foreign financial assets, at the end of the year and you live abroad. If you're single or file separately from your spouse.
All right. Well, the first thing is, remember, your FATCA filing is Form 8938.
Yep.
That's it. Okay? There's no other FATCA form. So when we talk about reporting thresholds, we're looking at some simple dollar figures. Are you single or are you in the U.S.? $50,000.
Okay.
Are you married in the U.S.? $100,000. Okay. Are you single and overseas? $200,000. Single or married and overseas? $400,000.
Okay. So pretty basic there. And just so you know, per irs.gov, you are considered to live abroad if you are a U.S. citizen whose tax home is in a foreign country and you've been present in a foreign country or countries for at least 330 days out of a consecutive 12-month period. So that's how they decide.
And that's actually a question that comes up a lot because a lot of our clients live overseas and they live at various places, never one place for 330 days, but really it's, are you out of the U.S. for 330 days? That's really the test we're looking at. And I'll tell you, if you are an expat, the streamlined disclosure for unreported FATCA replyings, FBARs, it is so better than being in the U.S. because your penalty base is 0%. Okay, when you file a streamlined domestic disclosure, the streamlined domestic offshore disclosure, which makes a lot of sense, domestic offshore, sure, why not? We'll put them together. Because that is, you live in the U.S. It gets a little nasty because if it goes on that Form 8938, if it's something that goes on at 8938, that is something that is subject to a 5% penalty. So your foreign corporations, stuff that isn't reported on an FBAR, that you shouldn't get penalized otherwise if you're going through the OVDP,
Yep.
you do get penalized on the streamlined. However, it's 5%, not 27.5%. And then also you're only looking at 3 years of unpaid taxes as opposed to 8 years with the full OVDP and all that 8 years of penalties and interest from 8 years ago.
Surprises me because generally expats get the short end of the stick. But in this case, it's a little different. It seems like that domestically you get penalized, and it's not, the thresholds aren't as good.
Right.
Let's give the expats something. Come on, they got.
Well, I also said that the expats don't have the Obamacare penalty if they don't get health insurance.
Got it.
So they got catch another break there.
Okay, and everybody's got to bear in mind penalties. There are penalties if you don't file or if you file incorrectly.
Right, and also your statute of limitations does not run. With a lot of these foreign forms, your 8938, your 5471, your 8858, 8621, they will 3250, 3250A, 3520. I always transpose those two numbers. God, I always will. Your statute of limitations on assessments does not run if you don't file it.
Got it.
Yes.
Okay. And the last thing to remember with this is even if you do file Form 8938, you still have to do an FBAR if the cumulative balance in your foreign financial accounts exceeds $10,000 anytime during the year. So doing an 8938 doesn't get rid of the FBAR.
Right.
It's both.
Right.
All right. What we're going to do is continue to talk about FATCA. We're going to talk about penalties, all sorts of stuff. And just because we're talking about FATCA doesn't mean we like FATCA. We'll get more in depth than that as we continue our series. Don't forget to like and comment below. And thanks for watching. IRS Medic, the law offices of Parent & Parent, LLP. Real tax attorneys for tough tax problems.